well, first of all, what we were doing yesterday was chapter 23, which was looking at growth of GDP. In other words, change in GDP over time. And right at the end of the lecture, we spoke about different kinds of growth theories. And the three different theories that we looked at was essentially a Malthusian theory, where populations grow, and this is not good for alleviating poverty. In other words, as long as populations grow, you will never get rid of poverty. That's the Malthusian story. Then you have the neoclassical growth theory, which says no, population growth is fine, but we also need to accompany that with productivity growth and technology change. And then the final discussion was on the new growth theory, which really just emphasizes the technology side of things and says, in fact, technology, what is it that increases technology? Technology advances when you throw a lot of resources at advancing technology. So one of the key reasons that you don't see capital fleeing from high-income countries is that high-income countries are still able to generate high returns because their technological advancement happens at a much faster rate, because they can dedicate more capital towards technology advancement. So that was where we ended the discussion yesterday. What I wanted to do today, just to warm you up, is go through two questions. This one is from this is from the last year's previous exams. This is question 10, and then I've got question 12, which we can go through as well. But I want to start with question 10. If you got any issues seeing it, then just come forward, because I won't be able to make this one bigger really. Question 10, which of the following statements is or are correct? And there's a series of 5 statements. I can't vouch for the grammar. It's not great, but anyway. So, question 1. Potential GDP growth is not determined by changes in population growth. Is that true or false? Option number 2. An increase in labor productivity causes a shift, emphasis on shift, in the production function. Option 3, an increase in labor productivity causes a movement along the production function. Now, I don't think the wording there is great, but essentially the point it's trying to convey is, does it just cause a movement along a single production function? Just the production function doesn't change and you have a movement along the production function. Option number 4, continuous improvements on labor productivity, or should be in labor productivity, will yield ever increasing changes in output, causing potential GDP, because potential GDP will be increasing as well. Option 5, the catch-up or convergence effect states that countries with higher GDP per capita will grow faster than those with low GDP per capita. So take 2 minutes, discuss it with your compatriots, and then we will discuss it together. So go for it. What do you think? First one, what do you think? False. Happy with that? Second one. Okay. I'm gonna side with those that say it's true. An increase in labor productivity, what does that do? That causes a shift in labor demand. If you shift labor demand, what happens to your production function? That shifts, right? We went through that yesterday. I haven't checked the video for it yet, but if you're still struggling with that idea, it is in the textbook. Otherwise, it will be in the video. Hopefully, it will be okay in the video. Have another watch of that video. Otherwise, come and chat to me if you're still not happy with why it shifts the labor demand curve. The request was made early on in the year to spend a lot of time on the graphs. So if people are having issues with this, we can still spend time on the graphs if people want that. But you just need to let me know. I'm not going to guess that you want time spent on it. So if you want time spent on it, let me know. Okay, so number 2, labor demand shift, production function shifts. Option number 3, an increase in labor productivity causes a movement along a single production function. In other words, the production function doesn't move, but you move along it. So that would be incorrect, right? Because the actual production function shifts. As I say, the wording is not ideal, but yeah. You happy that the production function does not shift? Right? Okay. I mean, what it's saying as the question is that the production function is not shifting, and therefore it's incorrect. Everyone's happy with that, right? Is that what you wanted to clarify? Yeah, number 3 is incorrect. Are you happy with that? 3 is incorrect, and 2 is correct. You happy with that? Okay. Option 4, true or false? True. Generally happy with that? Any issues? Okay. Option 5, true or false? False. Happy with that? Any questions? No? Okay. So 2 and 4. Right, let's do another one. This one's pretty straightforward. I'll read it out. How many years will it take for GDP to double if the growth rate is 0.7%? Okay, so you know the rule of 70. What does the rule of 70 state? That the time taken for something to double is simply the number 70 divided by the rate of change. So in this case, 70 divided by 0, 7, which is equal to, the way I would do it in my head, 700 over 7. If you've got something X growing continuously at a rate of R, for some time period T, right? Then you're going to get some value, Y, okay? If Y is 2X, in other words, sorry, I'm not sure why this thing keeps jumping around like this. If what you want is for X to grow to amount 2X, right? Then we can just solve this equation. We can cancel the X's. And you got e to the RT equal to 2. So we ln both sides, right? And you've got RT is RT times ln of E is equal to ln of 2, right? Therefore, ln of E is 1, so RT equals ln 2. So T is equal to ln of 2 divided by R, and ln of 2 is approximately equal to 0.7, right? So if your interest rate here was 0.01, in other words 1%, then the time taken for something to double would be 0.7 divided by 0.01. Or, if you give this as a percentage, so 1%, times this by 100, times this by 100, 70 divided by 1 equals, that's the time taken. Cool. So that's what we were dealing with yesterday. That was the economic growth side of stuff. Today we're going to start chapter 24. Going on to something a little bit new. Chapter 24 is a bit of a weird one, I think, in terms of the structure of the material itself. If you've done it before and you've wondered how does this chapter fit into everything else, it's never really clear how it fits into everything else, I admit. And a lot of the stuff that's spoken about in this chapter doesn't really seem to apply to other stuff that we do. So really chapter 24 in a strange way kind of sits by itself. It's not that chapter 24 is not related to any of the other material, it's just that we never really discuss how it's related to the other material. In other words, the textbook never really makes a strong link between chapter 24 and anything else. We can do that. I can spend time making a link, a strong link, and perhaps as we talk through the chapter, that need might arise, that's something you're interested in. But yeah, just bear in mind that it's not, it just doesn't sit very snugly with everything else. So if that's the impression you've got before, don't worry. That is exactly how things are. So, what is chapter 24 about? We're talking about savings, investments, and stuff. So, really, the catchphrase for all of that is flow of funds. Okay? So, we're talking about flow of funds. And our focus is on financial markets. And the things that operate inside financial markets are your financial institutions. In other words, what do we mean by institutions? In other words, companies or intermediaries. In other words, anything that sorry, I don't know why my pen is being so horrible today. Every day is a new challenge. Right? So things that operate within those financial markets. When we're talking about the flow of funds, what kind of funds, what are these funds for? What do we use them for? We use them for investments. That's why there's a flow of funds. And usually we say that these funds come from something called savings. This is a real simplification of the process to suggest that funds comes only from savings. Again, maybe we'll talk more in detail about that. Maybe we won't. It's not important for the rest of the course, but maybe it'll help the EU to structure everything better if we do talk about it, but we'll see. So you got investments and you got savings. People that are investing are essentially borrowing. People that are saving are essentially lending, right? So savings, lending, and investment are people. Investors or investment comes from the borrowing of funds. So you've got a flow of funds from savings to investments, from lenders to borrowers. And this happens through the financial market. Then there's this point over here where it talks about a government deficit or a surplus being explained through the loanable funds market, yet the text really does a poor job of that. And we're really not going to focus on that. Okay? We can talk a little bit about it, but it's not going to be something I will confirm with you, but I'm pretty sure it's not something that we're going to be testing you on. Right? Come towards the exam, if there's a change in that, we can discuss it. Or towards a test or whatever, if there's a change, but at this point in time, this is not something we're going to be testing you on. A budget deficit or a budget surplus in the loanable funds market, just because the textbook really doesn't do a great job of explaining this. Right, and then we can also talk a little bit about international borrowing and lending. And I'll show you in an equation how that works. I don't know if, I can't recall seeing it in the text, but I'll write it out for you and we can take a look. Cool. So if we're talking about financial markets, and we're talking about the institutions they're in, let's just get on top of a little bit of terminology first. So there's this idea of finance. What do we mean by finance? Well, finance describes the activity of providing funds. Okay? Providing the funds that will be used to purchase physical capital. So we have real goods, but the transaction and the way that we exchange real goods happens in terms of a monetary good. In other words, some nominal monetary instrument. In the South African economy, or the economy in which you are most familiar, we use things like either notes and coins or bank deposits. Maybe you do a direct EFT. That's the kind of money we use. So money finances expenditure. What do we mean by finance? In other words, it's the thing that enables that spending to happen. It happens through a medium called money. So money is what we use to pay for goods and services, or in other words, in any transactions. That is what we use money. That's what we use money for. We don't use direct barter. In other words, if you have carrots and I do lectures, I don't lecture you in exchange for carrots, right? I lecture you, you give me money, or you give the university money, the university gives me money. I go and buy my carrots, right? Okay, what do we mean then by physical capital versus, say, financial capital? What are physical capital means the actual machines, the tools, the physical things, the things that you can go in and actually touch, right? So for example, if you walk into Pick and Pay, they have tills, they have computers, they have carrots. Those are all physical capital. What do we mean by financial capital? Financial capital means the funds that firms are going to use to buy the physical capital. So what is financial capital? Basically money in the bank would be financial capital. Cool? How is capital and investment related? Well, the quantity of capital changes when we have either investment or we have depreciation. Investment means what? Investment is an increase in the quantity of capital, right? So investment increase. What happens when we have depreciation? Capital decreases. So the total amount of money spent on new capital is called gross investment, and the change in the value of capital is called net investment. So net investment means after we've taken into account depreciation. Net investment equals gross investment minus depreciation. Cool. What do we mean when we're talking about wealth? Well, people have wealth in many different forms. Savings contribute to wealth, and essentially savings is any amount of income that isn't either spent on taxes or spent on consumption. So in any one period, your savings will contribute to your wealth. So if you can imagine, your wealth is your savings at time period 0 plus your savings at time period 1 plus savings at time period 2, etc., etc. Okay? That would be your wealth. So what happens in a financial capital market, in other words, in a financial market, savings, which are the source of funds, are used to finance investment. Okay? So in other words, savings are funds supplied. Investment are funds demanded. Everyone with me? And the way in which these savings can get channeled towards these investments is either through a loan market, a bond market, or a stock market. We're not really going to talk much about stock markets. There's a little write-up about what a stock market is. We're actually not really going to talk much about bond markets, surprisingly, and that's where I think part of the confusion comes in. We don't really talk much about bond markets. I'm happy to talk about bond markets, but it's not something that's spoken about in the textbook. What we're going to focus on basically is just kind of like a loan market. Okay? Any questions at this point on the terminology? No? Then finally, what do we mean by financial institutions? They are just anything that's in the market that is essentially channeling funds. So you could have banks, you could have pension funds, you could have insurance companies. I think channeling's with a double L, actually. So we can call these things intermediaries. Oh gosh. Okay, intermediaries. Some more terminology, but let's just come back to that in a moment, and let's first just look at a diagram just to help cement what we've spoken about. So we'll come back to that slide in a second. We saw this diagram right at the beginning of the course, except now we've got a slightly more advanced looking one. Still got our households at the top, firms at the bottom. Firms and households interact via a factor market as well as via a goods market. That was our initial diagram. We've now expanded it to include, now we've got a financial market, right? So whereas previously we had output going from firms through the factor market to households in the form of income, households then spend their income on consumption, with consumption spending through goods markets. That consumption gets channeled to firms. The other kind of consumption that happens in goods markets obviously comes from government as well as firms themselves through investment. Now what we're saying is households, what they don't consume either goes towards taxes or towards savings. Taxes obviously go directly towards the government. Savings get channeled through financial markets. Where do they go? Well, either they become lending to the rest of the world, or they become lending to government, or it becomes lending to firms themselves. Okay? So household savings can get channeled either to government, to the rest of the world, or to firms. I mean, theoretically, household savings can also get channeled back to households, but that just complicates matters. Governments themselves can also contribute to savings. In other words, if government runs a surplus, which is to say it gathers more in tax revenue than it spends, it can use that surplus as a form of savings to channel through financial markets either to households or to firms or to the rest of the world. In the same sense, the rest of the world can, through financial markets, lend to our economy. How would the rest of the world lend to our economy? Well, if we are importing more than we are exporting, right? The value of our imports exceeds the value of our exports. What are we essentially doing? We are buying more from the rest of the world than what we are giving to the rest of the world. Are you happy with that idea? If we're taking more from the rest of the world than what we're giving to them, are you happy that whatever the difference is between those two numbers represents either us borrowing from the rest of the world or the rest of the world borrowing from us? And if we are if we are importing more than we are exporting, then essentially we are borrowing from the rest of the world. We are taking more than what we're giving to the rest of the world at that point in time, right? The way that gets balanced through the balance of payments and through the accounts, we'll talk about at the end of the through the national accounts. We'll talk about that at the end of towards the end of the course when we talk about international payments and exports and imports in far more detail. But if our imports exceed our exports, then we are essentially borrowing from the rest of the world. So through financial markets, the rest of the world can finance our borrowing. Yes?
I don't get how the concept of us importing more than we export borrow, because
Yeah.
I mean, for receiving goods for consumption, how is that
Okay. So let me put into a very, hopefully, simplistic example. You, sir, are a country, and I am a country, right? We're just countries. We're calling ourselves countries, okay? You have something that I want to consume today, right? I don't know, whatever. You got $100, okay? And I want your 100 Rand, so I can use it to buy whatever I want, right? It doesn't have to be 100 Rand. It could be that you have a cake, right? I want to take your cake and eat it today, but I haven't got anything to give to you today, right? In exchange. So we come to an agreement whereby you say, cool, don't pay me today for that cake, or don't give me something today in exchange for the cake, you can give it to me tomorrow. You happy I'd be borrowing from you? Even though I'm consuming it, I'd be borrowing from you, right?
I just thought that in the case of you actually having a transaction with you,
Of course, this actually happens. In other words, whereas I took a cake from you, I wouldn't actually have taken a cake from you. I would probably borrow 100 Rand from you and then use that 100 Rand to buy a cake, right? When we import and export, we don't barter goods across country borders, right? We go through the Reserve Bank and actually buy foreign currency, right? So if I want to buy goods from the US and import them, I first have to take rands, sell my rands to the Reserve Bank, buy dollars with those rands, use those dollars to purchase whatever it is I want in the USA, and then those goods come over to me, right? Now, in that process, if I don't have money to pay that guy right now, I can enter into an agreement with him and say, cool, I'll pay you dollars next month, right? So I get the goods today, I import them in, but I haven't paid for them yet. Then I'm borrowing, right? And I've imported and I'm borrowing. Cool. As I say, we'll talk a lot more in detail about that stuff when we do different chapters. Okay. So our financial intermediaries institutions operate within the financial markets. They are channeling the funds from whoever's saving, so we normally think of households as saving, to whoever is borrowing, and we normally think of firms as borrowing. So then just a little bit more terminology. What do we mean when we say insolvency versus illiquidity? This is just accounting terminology essentially. Insolvency has to do with net worth. In other words, if the value of your assets exceeds the value of your liabilities, you are solvent. If your liabilities exceed your assets, well, sorry for you, you are insolvent. What does liquidity mean? Well, liquidity is a short-term thing. Okay? Liquidity says if essentially my short-term assets, right, are greater than my short-term liabilities, then I'm liquid. If my short-term liabilities are greater than my short-term assets, then I'm illiquid. In other words, when I talk about short-term, what I mean, for example, is just like immediate payment. So I could have a company, I'll just draw it, maybe it'll make it a little bit more obvious here. Let's say I have a company and the total assets are in the form of, say, a factory, and the factory is worth 1 million Rand, and I also have cash, and the cash that I have is 1 Rand. Okay? Now my liabilities are, well, I have to pay people, so short-term debt, right? I have to pay people tomorrow. Short-term debt equal to 10 Rand. Long-term debt equal to 1,000 Rand. And then I've got some owner's equity, right? So plus equity. And my equity is, I don't know, whatever the balance is. Whatever the balance is between these assets and these liabilities. Are you happy that the value of my assets here exceeds the value of my total liabilities? Right? But I only have 1 Rand in cash and I need to pay people 10 Rand in cash. Right? I have a liquidity problem. I don't have a solvency problem, but I do have a liquidity problem. Right? I need to try and come up with some arrangement to sort out that liquidity problem. Okay, then we got interest rates and asset prices. When we talk about securities, what we mean by securities are things like stocks, bonds, loans. And all of these things are also referred to as financial assets. Okay? So any kind of securities, plus loans, which are kinds of securities, plus bonds, which are a kind of security, plus stocks, which are also a kind of security. All of these things are financial assets. Another word, essentially, for financial assets is securities. Okay. Now, the price of an asset or the price of a security, the price of a bond, the price of a stock, the price of a loan, price of any kind of an asset, and the interest rates are directly linked. Okay? The price and the interest rates are linked. What we mean by that is essentially something like the price is going to be a function of the interest rate. Okay? There's some kind of relationship. And in fact, what that relationship is negative. Okay? In other words, I put there negative, but in fact it depends which side of the equation we're on, so let me take that negative out of there. I'll clarify what I mean by negative just now. Yeah.
Do you mind writing about them?
Is it still giving problems? Sorry, oh yeah. I think we said pink was a better color or something. Pink better? Okay. Sorry, after yesterday when we made all those changes, didn't make the changes back. Okay, so what are we doing in this financial market with this flow of funds? Essentially what we're trying to do is finance investment. So again, how do we finance investment? Either through savings, through a budget surplus, or by borrowing from the rest of the world. When we talk about the real interest rate, what is the real interest rate and what is the difference between the real interest rate and the nominal interest rate? Well, the nominal interest rate is essentially, and it is the real interest rate adjusted for changes in prices. So nominal in this instance means pretty much exactly what we've dealt with before. When you had nominal GDP and real GDP, what was the difference between them? Change in prices, right? What's the difference between a nominal interest rate and a real interest rate? Same thing, change in prices. In other words, inflation is the thing that separates nominal interest rates from real interest rates. What is the interest rate then? The interest rate is the return. So what is the real interest rate? It is the return. Again, I apologize for my pen doing weird things here. Return on financial assets. Okay? That is what our real. So, well, actually, it's not linked. It's not specific to financial assets. It's the real interest rate is in fact the return on assets. The nominal interest rate is normally the interest rate that we deal with when we're talking about financial assets. So financial assets get a return which is the nominal interest rate. Real assets get a return which is the real interest rate. Okay? Capital in itself gets a return as well, which is a real return. So usually when we speak about a financial asset, the return that the financial asset gets is the nominal return. And when we talk about a real asset, the return that the real asset gets is a real return. What is the difference between them? Change in prices. Okay? When we talk about financial assets though, we don't normally talk about real financial assets. We only really talk about nominal financial assets. Because a financial asset is denominated in nominal terms. However, when we talk about the loanable funds market, which is what we're going to talk about now, we're actually talking about real financial assets, which sounds weird, and it is a little bit weird, and I'll explain why it's a bit weird in a moment. Sorry, question or statement? Sorry? Oh, it's a break time. Awesome. Okay, let's do that.